So in this segment, I want to talk about interest rates in the bond market. Along the way, I want to talk about the yield curve and something called the Fisher effect, and about expectations in general on this. And I'll probably do some current event stuff in the second segment on this, but I might weave them in as we go along. So in this first slide, we're looking at several different interest rates. So we're looking at that orange line, that is the federal funds rate. That is usually an overnight rate. And that's the rate at which banks loan each other reserves, or the claims on reserves. We talked about that previously. And that's a very short-term interest rate. Very safe, since these are usually collateralized loans that are put forward. And then you're looking at the second one. There is a treasury bill, a treasury bond, and that's a 10-year treasury bond. And usually we expect that something that's longer term like that to have a higher interest rate associated with it. People have a liquidity preference. They prefer to have control of their cash now, or have it tied up for less periods of time. So there's usually a liquidity premium that's in place, which should mean that under normal circumstances, long-term interest rates should be higher than short-term interest rates. That's why later on we'll talk about the yield curve. We usually think that under normal circumstances is going to be upward sloping, where shorter-term stuff, which is one end of the yield curve, usually has lower interest rates than the longer-term stuff that's out there. Then the third one is a BAA corporate bond. It's sort of a moderately risky corporate bond, and this is riskier. So we're looking at it should have a higher interest rate associated with it because it's riskier. So in looking at these, you have time is a factor, and so is the risk associated with the particular bond that you're looking at. And so we have these different bonds. They sometimes move together, sometimes move differently. You can see several periods where they've moved differently. If we look at that global financial crisis right in here, you can see that they lowered the short-term interest rates, so they lowered the federal funds rate, and the treasuries came down somewhat. But then what you're looking at is those riskier bonds actually went up in that period, and that's fairly common in periods like that. You can also notice some other periods where we're looking at the early 1990s when they again lowered the short-term interest rate, and in 2001 when they lowered the short-term interest rates, and those longer and risky ones came down, but not nearly as much. There was a gap forming between those for various reasons. In the 2000s, it was probably anticipatory debt increases, which if you have more debt in the future, then that'll raise long-term interest rates that are out there. And you can notice way back in the 1980s where you see those short-run rates going above the long-term rates. That's a huge inverted yield curve, but that was policy-driven in that they really drove up those short-term interest rates. They went up to where you're seeing these short ones go up almost to 20%. I talked with someone in Gunnison who ran a business in Gunnison during this period, and their financing shot up from about 14% interest rates, which is high enough, but their small business loan went up to 23%, and they were out of business within several months after that. They were running a sort of a tractor supply store back then, and their cost of financing went up. So that was short-term driven on that by the Fed actually raising interest rates or allowing interest rates to raise in that area. They started targeting reserves, and then they allowed these interest rates to skyrocket. Okay, so that's just looking. The first thing to sort of know about interest rates is that there's many of them, and they have different term structures, different risk levels associated with them. So there's many bond markets out there. There's not a singular one. Most textbooks kind of talk as if there's only one market out there, one interest rate that's out there, but there's many on those. Okay, so. One important one is that BAA, and I've corrected it for inflation here. So this is the real BAA interest rate. And And you can see that there are regimes in these. So, after World War II, you see these interest rates rather low for a long period of time, all the way up to the 1980s, where that change in monetary policy really drove up all interest rates over a period of time, including these medium-term risk interest rates that are out there. And they stayed high all the way up until really first the 2001 recession, but then they really came down as we were going into the global financial crisis, but then they shot up associated with risk. And they've been sort of much lower than they were back in the 80s in recent years. So just thinking about financial instruments in general. Why do we hold them? Well, one, they're a means of payment. Okay, so we can use them to purchase goods and services like money. They're a store of value. So the first two are similar to money that's out there. You can transfer purchasing power into the future, so there's a time factor that's involved in these. And they're also a transfer of risk. And this is where all the derivatives come in and all those other things that are out there. I'm trying to move the risk from a person who cannot handle it to a person who can handle it. So what makes these things valuable? So I'm thinking of this. Of course, the size of payment. Okay, the larger you get, the more they're going to be valuable. The timing. We usually think that the sooner you're going to get it, the more valuable it is. And then the likelihood of payment. So the more likely it is, the more valuable it is. And then the conditions on which the payment is made. So sometimes you might want it paid at a different time period, just so you can get the financing when you need it that's out there. But first three are the most important on that. Okay. These are some definitions. I just put them in the PowerPoint just so you had them in a handy spot on there. We'll go through each of these. But I want to talk a little bit about present value, and to set that up, I want to talk about future value. And I think most of you, since you were business majors at some point, you probably have had quite a bit of present value in a managerial finance course or something like that. But for those of you who haven't, I want to make sure that everybody's on the same page. This will help us understand interest rates in the bond market. So first, we'll start out with this idea of future value, and that's how much you're going to get in the future. If you invest now, what are you going to get in the future? And that's really a function of three things. And so that I there is the initial investment that you make, okay, whether it's $100 or $1,000. And then the I there, the little I, that's the nominal interest rate. And so that's your rate of return in this equation. And then that N is the number of periods or number of years that you're holding this for. And so essentially, how much you're going to have in the future is a function of how much you put into the investment, what the rate of return is it, or the interest rate on it, and the number of years that you're going to hold that into the future. Okay. One sort of interesting thing on this is that most people focus on the one that you can't control all that much, and that is the rate of return. The other two are really the ones that you control, how much you put aside, and the number of years that you're going to hold this on. So it's a function of these three. So just to give a quick example, suppose we have $100 and there's a 5% interest rate, and we're holding this for a year. So you just plug it into this equation, that $100 plus 1.05 raised to the 1 power, and that'd be $105 into the future. I mean, that makes perfect sense when you're just thinking about a 5% return on that. Okay, that's the idea of future value, or the equation for it. And let's take another example. So in the future, what is the future of investing $200 4 years into the future with an interest rate of 7%? And then all you do is you take that 200 times 1.07, or 1 plus the 0.07, raised to the 4th power, and it comes out to be $262.16 on that. Okay, so that's just an example of using the future value formula on this. Okay, now just to understand how this is operating, let's look at that initial investment where we had $105 of future value in that, and let's double the rate of return. Okay, so when we do that, of course, if we had a 10% interest rate on it, instead of earning $5, we'd earn $10 on that. Okay, but what if we doubled the initial investment? So if we double the initial investment and keep the original interest rate on there, we'd earn $10 on that, and we'd have $210 in the future. So we'd have quite a bit more, but only because we put more aside on that. What if we doubled the time frame? So we held it for 2 years instead of 1 at that 5% interest rate. Then we'd have an earnings of $10.25. So we'd have $110.25 on it. That's doubling the time frame. So again, each of these is going to affect the future value of this. And then let's look over a very long period of time. If you move that number of years, that end from 1 year to 30 years, then we're earning $332.19. And so our future value from that initial $100 investment is $432.19 on that. Now, you can also, if you were to really increase the rate of return, so a 30% return, you'd also have an increase that's associated with it. But that obviously, since there's a risk-return trade-off, it's often forgotten. Sometimes people think that you can have more return without risk, but markets are pretty good at eradicating that away. So if you have that kind of return, you're also going to add risk to this whole thing that's out there. Okay, so let's look at an example over time and think of the idea of compounding. Okay. And so compounding means that when you get interest on something, that interest is added to the base. And so in the next period, when you're getting interest on something, you're getting interest not only on the original amount that you put aside, but also on the additional interest that goes on. And so this tends to build on itself over time. And this can make huge differences over a very long period of time. It's why there's such a push to get people to open up, a Roth IRA or something like that right out of school, and just to get started on saving for the future in a long period of time, over a long period of time. So what you're looking at is that on the left-hand side of this, we have compounding taking place. So you have the initial investment that's taking place there. So in the first year, of course, it's you're getting interest of 50 on this, okay? And so your total is 1,050 that you earned in that year, but of course that's going to increase the base for the next year. Now, as opposed to what's on the right-hand side, we're not increasing the base each time. So each time we only get the interest on the initial amount that we put aside. So, if you did this over a 30-year span, you can see the enormous difference that takes place by increasing that base, by having that type of compounding that kicks in. So after 30 years of this, on the right-hand setup that's out there, you've earned quite a bit. You're at you started out with 1,000, and with a 5% interest each year, you're up to 2,500. So you've increased things by 1,500. If you look at the left-hand side, though, given that the base is going up each time, you're getting more and more interest. And you can see that by looking at that column under interest and seeing just how much the interest each time goes up dramatically, whereas on the right-hand side, it stays at 50, 50, 50. Now you're getting 5% of a bigger base each time. And over a 30-year span, this moves you from the 2,500 to a total of $4,321.94. Okay, so there's quite a significant increase in that. So that's the idea of compounding that is really important in thinking about investments over a very long period of time. Okay. So now let's, from that idea of future value, we can reverse it or invert it, if you will, and look up the concept of present value. And this is taking a value or a return that you're going to get at some time in the future and putting it into today's terms. And so the idea is that if you had the money now, you could do something with it and earn interest on it. So we want to equate future returns to present returns through an equation that links the two. And so it kind of inverts that future value equation, in which you have future value now as your reference point, and then you're going to discount that as, and what you're going to do is you're going to divide that by 1 plus that interest rate raised to the number of years in the future that the return happens. Okay, so just to go through a real quick example on this, suppose you had $100 received 2.5 years from now at an interest rate of 8%. You just take that that $100 on the top, and then you would divide by 1 plus 0.08, and it will be raised to the 2.5 years that are up there. And it comes out to be $82.50. So it's been discounted from $100 to $82.50 in that period. Now note, just if you were to take that $82.50 and throw it into the future value equation, then you'd be multiplying by that 1.08 to raise to the 2.5, and you get the $100 again. So this is just sort of looking at the two in relationship to each other. So future value is how much you're going to have in the future at a constant interest rate. This is sort of looking at a future return and seeing how much it's worth in today's dollars that are set up there. Okay, so just to look at another example very quickly. So this is what is the present value of $1,100 4 years in the future? Now you could have returns at all sorts of different stages and put them all together in this, but I'm just going to do a real quick one here. And so we're saying the interest rate is 6%. Okay, and so we take that $1,100, we divide by 1.01 plus 0.06 or 1.06 raised to the fourth power. And so this would come out to be $871.30. So it's just plugging into the equation. A managerial finance class would go through endless varieties of present value. I just want you to get the idea of it so that we can understand how the bond market works, because there's an important component that kind of comes out of this concept of present value. Okay, and a couple quick things. What really matters is this combination of changing interest rates and time. So this is one of the reasons why there's a lot more volatility in long-term bond markets than short-term bond markets, because you get this massive change that takes over if you combine interest rate changes with a long period of time. So what this diagram is showing you is on the horizontal axis is years to payment, and on the vertical axis is the present value of something. And then what you're looking at is at, so if you're taking a present value at just 14.4 years, then you're seeing this decline take place as it goes out to 28.8 years. And this is shown even more clearly. This was at a constant 5% interest rate, but let's look at if we change the interest rate and combine interest rate changes with increasing the years. So looking at 1% and taking the present value of $100 payment, say 1 year in the future versus 20 years in the future at a 1% interest rate, that moves you from $99 down to $81. But look what happens when you move it up to a 5% interest rate and you have a longer period in there. So you start out 5% interest rate, it's at $95 in 1 year. But if this goes out 20 years, the present value of it is $37.69. So you get a massive change when you combine a higher interest rate with a longer time frame that's out there. That's sort of the key understanding that you want to have when you're thinking about present value calculations on this. It's the combination of those two. Okay, and again, this diagram is showing you the same thing. It's an important concept. So what you're looking at in this one is you're looking at differential interest rates and the discounting that takes place in 1 year, 5 years, 10 years, and 20 years. And so you get that much longer one where you combine a higher interest rate and more years that are taking place. Okay, so that's the key insight from those diagrams that are out there. So just to recap a couple of things on this. One is your present value is higher, the higher that future value is, although you get way far out and even the future value isn't all that important because it's the interest rate and the time that really kick in as you get longer and longer time frames on it. The shorter the period is until the payment, okay, and the lower is the interest rate that's in there. All of these things will give you a higher present value on something. Okay, so let's take a particular type of bond. So a bond is just a fixed income asset. It pays you a fixed amount each year, and this particular structure that I've set up here is a zero coupon bond. Coupon bonds are called that way. I actually have one that my grandmother gave me that I still have the coupons from. And so these are bonds with little coupons down on the bottom that you could rip off and turn in. But the idea of a coupon bond is that it pays you a fixed amount each year. In this case, what I put here is a $100 bond. So it's going to pay you $100 each year that you get it. And so if we want to find out what the present value of this, what we do is we just take that $100, and then if we wanted to figure out the time frame, if it's just to a 1-year bond that we're looking at, that's just going to be raised to the 1 power, that n becomes 1. And if we're thinking about a 4% interest rate, then this is going to be 100 over 1 plus 0.04. So this is the structure of this is going to be important, because what we're looking at is, in this case, we have a fixed interest rate. But what is going to be vary when we get into the bond market is actually the price of bonds, not the interest rate of bonds. The interest rate is going to be a residual. But in this case, we're setting it up to try to figure out what the present value of something is. And so when we get that, we get $96.15. Now, notice that if we were to raise up this interest rate from 4% to 5%, okay, then the present value of this would go from $96 down to 95.23. So 96.15 to 95.23. This gives us a really important principle that, as we see, if this is what we ended up valuing at and paid for it, okay, if we were to sort of set the price over here, then one of the things we'd notice is that as the price goes up, the interest rate goes down, or as we're thinking about it, as the interest rate goes up, the price goes down. So bond yields, interest rates, and prices of bonds go in opposite directions. That's sort of the key finding that I want you to have out of this, that given that present value setup and given how we value bonds, that once we know the price, we can either sort of figure out the present value of something, knowing the future value and the going interest rate, or once we know the price, we can solve the equation for the going interest rate on that. But the key finding that's important for the bond market is that when you have a structure like a zero coupon bond like this, that so when we have a structure of this, when you have when you have a structure of this, when there's just a face value in this and there's no sort of extra payment on it, that what you're looking at is as the price goes up, the bond interest rate, the yield will go down. Okay, so that's the key finding from this. So now let's go to the bond market, which was, where we're headed on this. And once we know that that prices and yields go in opposite direction, it means that when the price is going up over here, it means that the going interest rate is going down. Okay, so just for instance, if we were to have a massive increase in the supply of bonds, works like any other supply market out here, okay, what would happen is, of course, like any supply, that would bring down the price, okay, but that would drive up the interest rate, okay? Since we're setting this as the price is equal to some face value over 1 plus the interest rate here, then what we're looking at is we also know that when the price goes up, okay, since the interest rate's on the bottom, the interest rate is going to have to go down. That's going to equate those two. Okay, so so what we're looking at here is that we, in most cases, sort of the interest rates are what are reported, but this is a supply and demand framework, and it's the price of bonds. It's the thing that fluctuates, and then the yield is a residual after that. So in the case I've put here where there's an increase in supply, that might have happened because, well, it might be that firms are expanding and they want to finance their operations, so they're issuing a lot of new debt. If it's a government bond market, it might be that the government is doing a bailout, is doing a fiscal stimulus, and they need to finance it by increasing the amount of bonds that they're putting in circulation. So all of this would increase the supply of bonds, would bring down bond prices, and it would increase interest rates. That's what happens in the bond market. Now, this is just a supply and demand framework. The demand for bonds comes from people wanting to do some savings and get a return on it. And the supply of bonds comes from firms and the government trying to issue debt in order to finance something that they want to do. Okay, so we can look at what are the things that shift the bond supply. Well, one of them is the government needing to borrow. So when they need a a lot of new financing of fiscal policy or things like that, then they will issue new bonds. Okay. When business conditions improve, then you get firms wanting to expand operations, so they'll often issue new bonds. They'll want to take on some debt so they can finance those operations that are out there. And then, since this is a fixed income asset, inflation weeds away the real value of it. And so when there's inflation, then it's actually cheaper for the debtors. It actually makes it so that those interest rates that they're putting forward are going to, in a real sense, be less. So what you'll see is it's more, debt becomes cheaper to get, and so they'll issue more of it that's out there. Okay, and all of these things will increase the supply of bonds that are out there. On the demand side, increases in wealth are going to increase the demand for bonds, because individuals will want to put their wealth and they'll make a choice between stocks and bonds and liquid assets that are out there. But they'll have more of all of those. So this will tend to increase the demand for bonds that are out there. Again, if there's a fall in expected inflation, then if you're demanding bonds, it's the reverse of when we had inflation driving the supply side. If there's a fall in inflation, then those people will look at bonds as a better asset to hold, because with a lot of inflation, it's weeding out the real returns of those payments that they're getting. Whereas if there's not much inflation, it's going to hold its value over time. Okay, and then there's a substitution effect, thinking about the relative returns on stocks and bonds and real estate and other types of investments that are out there. If bonds look like a relatively better return, then you'll see the demand for bonds increase on that. And the same thing when you're looking at risk. If bonds seem less risky than some of those other types of things that you can hold, assets that you can hold, this will also increase the demand. And the last one is the idea that if they're viewed as more liquid, that'll also increase the demand for them. This was a big one during the global financial crisis. Why did everybody want to hold U.S. government debt? It was because it was seen as extraordinarily liquid. And so there was almost an unlimited demand for this government debt that's out there. Okay, so I'm going to stop there. I'm going to go to the whiteboard in the next segment and talk a little bit more about the bond market and some things that are affecting it, and then I'll come back to this after that. But I'm going to stop this for now. This will be part 1, and then I'll go to part 2 after that. So.